Stock market volatility has been on the rise. Today, we're going to dig into the stock market, check in on some updates on the economy, and add some additional context on how we view the current situation. Let's start with the stock market. Through March 11th, the U.S. stock market, represented by the S&P 500 stock index, is down about 9.3% from all-time highs set in February. Notably, the largest tech-oriented companies in this index, commonly known as the Magnificent Seven, have fared worse. What we are currently experiencing is the largest market decline since October of 2023. Now, notably, in 2024, we did have a market decline of about 8.5%. However, it was short-lived. So what is causing the market decline? In one word, uncertainty. Financial markets hate uncertainty. Tariff headlines in particular are front and center and seem to change daily. We know that estimates of economic activity as measured by GDP are being revised down. Importantly, however, the downward revision was primarily driven by a surge in imports ahead of tariff implementation. In short, economic activity is uneven given that people and businesses were front-running the tariffs. Looking across other economic data points, unemployment is relatively low, household debt has been manageable, and favorable credit conditions continue to support demand. Now, of course, this data can change. However, at this time, there's not yet evidence of a broader economic slowdown or recession. Now for some context. Current market decline aside, let's review historical occurrences of market declines. Looking back over the last roughly 100 years, a 5% market decline, known as a mild correction, occurs about 3.4 times per year. A larger, moderate correction, a decline of 10% or more, occurs about 1.1 times per year. From a pure market movement standpoint, the decline we are experiencing now is pretty much in line with what has occurred historically. One difference is that we haven't seen market volatility for quite a while. In fact, the opposite has been occurring. Over the past 2 years, the stock market has been doing pretty well. When uncertainty is elevated, we point to key fundamentals of investing. For one, remain diversified across investment types. We believe that no single investment or asset class should determine the success of your future. Checking in on markets this year, U.S. large company stocks for the year are down through March 11th, whereas international stocks, bonds, precious metals, and commodities are all up. The takeaway is that owning a diversified portfolio means that some investments zig while others can zag. Diversification helps smooth out the overall ride. We know that market volatility can feel unsettling. Seeing your investments drop isn't easy, and it's completely normal to feel concerned. But uncertainty is part of investing, and these periods, while challenging, have historically been overcome. That's why we stick to a disciplined strategy, one built on diversification and thoughtful planning. Thanks for tuning in, and as always, if you have questions, we're here to talk.
Hey, thanks for listening to our podcast. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment